This is a brief introduction to financial analysis, and it's based on Chapter 1 of Analysis of Financial Statements by Pamela Peterson-Drake and Frank Fabozzi. Financial analysis. It's a selection, evaluation, interpretation of financial data. And what you'll find is there's a tremendous amount of data available, and one of the challenges is trying to sort through all of that data and try to figure out what's the most important to use when we have a particular task such as valuation. So there's a wealth of information, and our job as an analyst is to wade through all of that and then make sense of it. When we refer to financial reporting, we're talking about the information that's coming from a company. And we can talk about financial reporting that was done years ago, the current financial reports, the press releases, the earnings announcements. Now, the financial analyst collects all this information and figures out the relevance and the quality of the information. And quality is an important element here, because with all this information that is coming from the company itself and other providers, you'll find that some is good quality and some you have to really dig deep and figure out if it's really useful, but also if it's quality. That is, are we dealing with generally accepted accounting principles? Now, the analyst also takes all this information and analyzes it. And the key here is to look at unusual patterns, what type of accounts and what's happening with these accounts over time, different transactions. There's a lot to it, not just looking at published financial statements. Now, why should we take care in performing a financial analysis? Because if we don't, we might miss something very important. Now, Enron is a classic case of a corporate scandal. It was a natural gas and electricity company that was very large. Its CEO and CFO were featured on major business magazine covers and articles written about this. But they were using a specific form of accounting, mark to market, and they were able to hide the trading losses. They also claimed profits before the actual assets were put in place, the ones that would have generated those profits. And they transferred these assets to off-balance sheet entities before the losses were actually realized. They had a number of suspicious transactions in what are called special purpose vehicles, and the primary assets of these vehicles were shares of Enron. So these were entities that were off the balance sheet. And now they were mentioned in footnotes, but you had to dig very deep, and it was very confusing, very challenging to figure out what was going on at the time. But this caused quite a stir. So where does all this information come from? Well, there's reporting by publicly traded companies, and they have to file statements with the Securities and Exchange Commission. You can find them at www.sec.gov. And in that information, there's going to be 10Ks, which are the annual reporting, 10Qs, which are actually the quarters reports, 8Ks, which are any type of announcements, press releases that the company makes. You can also find economic information by federal and state government and different agencies. So you will find, for example, the Department of Labor is very useful for finding some Bureau for Labor statistics, part of that, if you're looking for unemployment statistics. And so there are a lot of agencies you can look at for information. You'll also find a great deal of information at the Federal Reserve Bank system. They have the FRED system, which is out of the St. Louis Fed. And the FRED system has time series information on all the major indicators. You can also find information in trade associations. So if you're looking at a beverage company, then you'd want to look at a beverage trade group to find information that may be very specific to that industry. Now, the information that the companies provide are going to be those that are required. For example, their proxy statement. If you're talking about something that has to be put to the vote by shareholders, you can also find information on compensation of all the executives in the proxy statement. And the proxy statements are going to be generally every year unless there's a special vote to shareholders. And in that you'll find a table of compensation, which is very revealing. You also have 8K filings, and these are a myriad of different things that can be reported here. You can have any type of press release, any event that occurs to the company that's material meaning it would affect the value of the company. And so those are filed, and you'll find those in the SEC website as well. The 10K is the annual disclosure. It's the most comprehensive that you'll find for a given company because there's required disclosures with that. So not only do you find the standard balance sheet, income statement, statement of cash flows, and other statements, you will also have a great deal of footnote information and company description. 10Q is the quarterly equivalent to the 10K, but is briefer than the 10K. In the 10K, there's a section called Part 1, and here you'll find the description of the business. Very interesting will be the risk factors. Now, some of this is boilerplate. That is, you'll find the same wording for company to company, but hidden in there are going to be some interesting things that are very specific to the company. Unresolved staff comments mean the SEC's raised some issues, and these are things that haven't been resolved yet, so they're uncertainties, so they're part of risk as well. They'll describe their properties, any legal proceedings, mine safety disclosure, which is out of a recent law that everybody had to disclose that. Part 2, you'll find the market for the stock. You'll find selected financial data, some highlights. Then you'll have the MD&A, which is Management Discussion Analysis, which is the management's view of what went on during the period of time. And then you have the quantitative, qualitative disclosures about market risk, financial statements, if there's a disagreement with accountants, which should get your attention, that would be disclosed. There'd be a statement on controls, internal controls and procedures. In Part 3, they're talking about directors, officers, and corporate governance. They'll have executive compensation, security ownership, certain relationships. Now, related transactions, that's something that should get your attention. If there are transactions between the CEO and the company, say, for example, a large loan, something of that nature, you want to take a close look. Also, disclosures about director independence. That's very important in understanding how the board operates and the degree of independence. And then, of course, the accounting fees and services. In Part 4, you have the financial statements and then a summary. You also have notes to the financial statements. And the first one's going to tell you their policies and practices for accounting. For example, what method of depreciation do they use? What method do they use for accounting for inventory? Then you'll have a note on inventories, some breakdown of the type of inventories. You'll have property, plant, equipment, taxes. Retirement-related benefits are your retirement, your pension, and your post-retirement benefits, if there's some health benefits that are given post-retirement. You'll also have information on segments, stock options, and any events that occurred that were not part of the annual period but were relevant to and should be disclosed. So if something happened, say in January before the statements are given to the shareholders, then that would be information. There are two laws that had great significance in terms of disclosure of information and regulation of firms in the past few years, and one is the SOX Act and one's the Dodd-Frank Act. The SOX Act is the Corporate Responsibility Act of 2002, but it's more commonly known as the Sarbanes-Oxley or the SOX Act. And it was a direct response to Enron. So if you look at the Enron scandal and you look at SOX, you'll see that they just tried to hit on all the things, because there weren't just a few things that went wrong at Enron. There were many things that went wrong in Enron, and that gave rise to this particular act. And basically, there's more responsibility given to the corporate officers and to the accountants in terms of monitoring accounting disclosures. There's also increase in 8K, when an 8K has to be released. And if you look at the SEC website, you'll see that it used to be there'd be a few 8Ks for each company. After Sarbanes-Oxley, each company has many 8K statements because they are required to disclose a great deal more than they were prior to this act. The Dodd-Frank Act is the Wall Street Reform and Consumer Protection Act, and most people refer to it as Dodd-Frank. And it's in response to the financial crisis that we had, with those basically a banking crisis. And basically this increased oversight and regulation of financial service firms, but also of independent public accountants. So it not only regulated financial service firms to a great deal, but it also created, for example, there's now a body that overlooks the independent public accountants. So, and you have increased disclosure of financial service firms, but that also spilled over to other areas as well in terms of disclosures. And there's also an additional requirement that they disclose the relationship between the corporation CEO's compensation and the median employee compensation. So what you'll find is a lot of news attention to this particular item every year, because at some firms that's a significant difference. Well, in most firms it's significant difference. Some firms it's really absurd difference.